Money is there. Now we come to Switzerland. This is a safe haven country. It is small, a well-known country for neutrality and financial stability. They have a lot of gold. At one time, they were the biggest gold holder in the world. What is its currency? Swiss franc, which we call CHF. Its location is in Europe. Major industries.
What are its industries? Banking, finance, pharmaceuticals, precision instruments, basically luxury instruments like watches, etc. Its economy is export oriented. Major trading partners are Germany and other European countries. Now it has the SNB. The SNB sets the monetary policy. It aims to keep inflation under control below 2% per year and maintain the stability of the Swiss franc. Keeping the currency stable and inflation at 2% is its goal. The Swiss National Bank is known for intervening in the forex markets to prevent the franc from becoming too strong. Just as we learned, the Swiss National Bank also learned that it directly interferes in the market to manipulate its currency, sometimes strong, sometimes weak. It has tools, the same tools. The SNB sets a target range for the 3-month labor rate, the interest rate banks charge. These interest rates are its tool, using open market operations, repo transactions. Repurchase agreements manage liquidity and influence interest rates. The same open market operations and interest rates. These are its tools. Then you have the Swiss story. The Swiss franc, nicknamed Swissy, is a safe haven currency. Investors often buy during times of uncertainty. Now what? Now, given the current situation, first the dollar is safe, then the yen is safe. The Swiss franc has reached the lowest point. Switzerland is one of the few countries that still backs its currency with gold reserves. This gives the CHF a strong correlation with gold prices. Why? This is a gold-based currency, meaning it is not gold-based, but the reserves of its central bank are mostly gold. So, it competes with gold. What are the important economic indicators for the Swiss franc? Gross domestic product measures the overall size and growth of the Swiss economy. Retail sales show how much consumers are spending. Consumer price index. Consumer price index measures inflation in Switzerland. Balance of trade shows the difference between Switzerland's exports and imports. What moves the Swiss franc? Gold prices. Higher gold prices tend to boost the Swiss franc. Developments in the Eurozone, United States economic and political events in these regions can influence the franc. Risk sentiment: when investors are wary, they often buy the Swiss franc as a safe haven. When risk sentiment is poor, yeah, we learned that the pound goes up in good sentiment. What did we learn about the CHF? It goes up in bad sentiment, gross exchange rates. Changes in other currency pairs include the CHF and USD. Mergers and acquisition companies buying and selling businesses in Switzerland can influence the flow of money and the exchange rate. Now understand this pair. USD CHF is also traded in lots. Pips are calculated. Pip value is in Swiss francs. Traders need to have money in their account to make any trade. USD CHF and USD CHF are the most active during the European trading session. You must always be aware of SNB potential intervention in the market. Suddenly, without announcement, without any reason, the bank can interfere in the market. So you have to always be on your toes. How to escape stop losses in profit as well, so that suddenly the bank does not take the entire move from plus to minus. You have to keep an eye on their economic and political developments happening in the Eurozone, because it is within Europe. You have to keep a close watch on it. Then you have to use Euro CHF to see if CHF is getting weak or strong, because Euro is anti-dollar, CHF is also anti-Euro. If the euro is mostly going up, then the Swiss franc mostly goes down. So if the euro Swiss franc is rising, it means the Swiss franc is weakening. And if it is falling, it means the Swiss franc is strengthening. Last but not least, we have the giant whose currency we will not trade. But its presence is so significant, it affects every currency. We have China, the emerging giant. Its most popular country with a growing economy uses it. The Chinese Yuan as its currency, also known as the RMB. It is located in East Asia. Major industries include manufacturing, agriculture, services. Trade is a major player in international trade, both as an important exporter. Every country will also have China as a major trade partner, so it affects all the world. The People's Bank of China, PBC, sets monetary policy. What is its aim? It is to keep inflation under control and support economic growth. The People's Bank of China is known for making significant and aggressive policy changes. Suddenly, it will make big policy changes to boost its economy, or sometimes to control consensus, and they do this suddenly. Their mood can change at any time. It uses the tools of interest rate changes. It can raise or lower interest rates to influence the economy. Reserve requirement ratio, RRR, the PBC can change the amount of money banks are required to hold in the reserve. Why? The less money you have to hold in reserve in the bank, the more money will go into the economy. Thus, when the economy needs a boost, they change the RRR, they reduce it.
When they need to be strict, they increase it. They basically do not conduct open market operations.
They adjust the triple R under the central banks. Then, the Chinese Yuan, also known as RMB, is gradually becoming more important in the global economy. It's currently pegged to the US dollar. It is almost fixed with the US dollar.
But China has been taking steps to make it more freely traded. However, so far, China has a fixed currency rate with the USD. What is the advantage of that? It maintains stability
for each other. So this adjustment does not affect the sudden fall or rise of the currency. The yuan has been a source of tension with the United States and other countries because when the yuan weakens, China wants to take advantage of it against the dollar. So for that reason, they want to strengthen the renminbi, the CNY. But the issue is that it is an export country.
So it's a lot of tension, problems.
It has become an issue in BRICS and all those discussions. Especially after the Russia-Ukraine war, CNY got quite a boost, especially from Russia. So Russia has done a lot of trading in yuan.
Now its economic indicators, the GDP measures the oversized growth of the Chinese economy. The CPI has such information. China's trade balance shows the difference between China's exports and imports. We have the Caixin Services PMI and Manufacturing PMI, and then there is the government's own services PMI. Caixin is private, the other is government, so we need to keep an eye on the manufacturing PMI in both Caixin and the other one because this is a manufacturing-based economy. What is its main focus? It is on manufacturing. If its manufacturing rises, the economy rises. If manufacturing falls, the economy falls.
Now, how do we use China's economic report, even though the yuan is not freely traded?
Chinese economic data can still affect other currencies, especially the Australian dollar, because we discussed earlier that in Western markets, the Australian dollar is used for currency trade with China. Who is Australia's major trading partner? Who imports the most resources from Australia? China does. Strong Chinese data can boost, Aussie weak data can weaken. You keep an eye on Chinese data. Pay close attention to recent Chinese economic data because if you are trading the Australian dollar, be aware. The influence of Chinese economic performance and sentiment in the market. If China's conditions are going well, there will be a risk on mood. If China's situation worsens, there will be a risk of mood. Then the currency that weakens in risk off will weaken and the one that strengthens in risk will strengthen. So we need to keep an eye on this. The major economy is concerned in complex ways. We have discussed as much as we could, but there are many more things. Many such things that we cannot discuss in this time. Even if we make a 4-year degree on it, it would still be insufficient.
So understanding this connection, the role of central banks, and the impact of economic data is crucial for successful trading. Continuous learning and staying informed about global economic developments are essential for navigating the markets. You need to keep this in mind and act accordingly, keeping an eye on the entire economy, because you have done technical analysis, but fundamental analysis,